So this is a form of liquidity. Liquidity is formed in many different liquidity is formed in many different ways, and we find that most of the time this has been a problem to be able to identify these levels, both on our even I've seen most members in the community still struggle with this. So how do you identify this level? You realize that whenever you have a point of interest, you have when you have a pullback on a market structure, depending whether it's bullish or bearish, as long as you're looking at the market structure, you'll notice that if the price goes higher and gives a pullback and goes away, mostly on these lows here, this is where most people put their stops. And if this is where they are going to put their stops, this means that there's always a demand below. But the problem is always that on this particular level where you're having your liquidity level, there's always a demand zone here, right? There's always a demand zone here. And most people believe that a low that leads to a break of structure, for example, a low that leads to a break of structure has a higher probability. But this stop low, again, is the same low that contains a lot of stop loss. This means that when the market returns here, most of the time, it rarely respects that level and go higher. Sometimes it does, but some other times, to just come, react, and violate the level, goes below a level, below a demand zone, below your demand, which is acting as an inducement. After mitigating your extreme level, then it will pump to the upside after mitigating your demand zone there. There's another way of how this structure behaves. Now, if we look at this other chart here, for example, if we look at this one here, on this one, what we see on this chart is that here the structure look a little bit different. What I mean is this. Sometime you're going to have price going higher, coming down, and going higher and creating an internal structure and creating a new internal high. Then this low is a liquidity level. If the price comes back here and takes out this level and mitigate anything here, for example, mitigates something here, example here. Just a minute, let me do something here. So when you have a zone like this, you realize that it comes a time whereby you have the market structure attempting to come to your area, to your zone of interest. And if it comes to that zone of interest, for example, here, when you have a level like this, don't know what's happening in my background. When you have a zone, like this, most of the time you're going to realize that your market structure will just come back here, mitigate this level, and try to push to the upside. Mitigate this level and try to push to the upside. The same way, you can have a structure like this. Let me use another example here. There's a scenario whereby you'll have a structure whereby let's say, in a proper way, price creates a pullback and takes out that inducement and it's now pushing to the downside and create something like this, right? And fail to break this level, right? It can come even to this level and fail to break this level. For it to sell properly, it has to take out either this high or that high, but at least it has to go higher I take out some liquidity at this level or this level, for example, here. And that's when you'll see it pushing lower to take out this particular filling level here. To break that particular structure. You realize that this level is being used as a liquidity, this area. It's being used as what as a liquidity level. So it has to take out that particular high for it to go down. So you look at this, where were we? On this market structure here. When it creates a pullback that leads to a break of structure, for example, when you have a zone like this, the low that leads to this break of structure, this is a break of structure here. You realize that this is not your standard liquidity, this one, because this liquidity, this low, this previous high, sorry, that led to this break of structure, it's not the source of the whole move. The whole move starts from here. This means that the price can take out this level and come back even here and react and come here again and react and go higher until it takes out the whole zone that led to the break of structure before you get that sharp drop to the downside. So you realize that this again is going to be what? A failed supply zone because the main liquidity was supposed to be there. Yeah. The same zone, this is just the same one whereby you have a break, market leads to a break of structure. This means that it has to go higher, but you get a supply zone above that high that led to the break of structure, and you get a drop to the downside. And another zone that you can look at, for example, here, whereby the price creates so many levels to the downside, so many zigzag levels, and it can end up even breaking the structure, for example, like that, and it continue going to the downside. This means that for price to go to the downside again, well, it has to go higher. Take out the source of the push to the downside like that, and clear that level as well as a liquidity, for example. So this becomes your main liquidity level. So let's look at this on this market structure here, and I'm sure we're going to get to see something. Yeah. So for example, you can see here. Let's look at this record structure here. Example. You can see here we have that record structure. Once you have this break of structure here, once you have this break of structure, you realize that for selling, most people who want to sell, they always want to look at this level as what as their first supply zone, whereby they expect the price to return here, right, and look for sell. This is what they want. And they have this level as their decisional, and they have this area here as their extreme supply zone. You see here. So most of the time, this area has a low probability because when the price returns here, this zone, most present sellers, they go their stop loss above here, around this zone. So price, most of the time when it comes back, it will attempt to take out the stop loss, and it can even fail to go to extreme and still drops to the downside. So let's see what happens here. For example, this is our extreme supply. Yeah, so let's just see. See, when the price stops here, of course, you'll be looking for a short position there, and you can see what happens. Price goes below the level and takes out that level. So this means that if you're looking for a short position here, and maybe you place just your stop loss above this zone and you're targeting either this low here, you realize that there you're going to hit a stop loss immediately because the price will hit that level and take you out. And sometimes you can say that, okay, you're going to wait to your extreme level. Yeah. Now, if you're to extreme level, you might be lucky or you must miss again the move because sometimes the price again will not go to the highest point. Why? Because all of this is your order flow. All of this is what? An order flow, and you know the power of an order flow, what it does when the market mitigates the order flow. So this is also another zone whereby the price will just manipulate you. Why? Because this high is a high that led to that break of structure, and the pullback, there's no pullback here, there's only pullback here. So this means that this was your liquidity level that was supposed to be first taken out. Yeah. This was your liquidity level. So let me remove this. And you realize that price has taken out that level. See, taken out that level. So after this level has been taken out, you can now start preparing to look for a sell. For example, let me see. Can see something like that. After price has taken out this level, now you can plan yourself and put yourself maybe here and say that if the price returns here, you can look for a short position if it can return. But the main important point is that you want to wait for that liquidity being taken out. And when the liquidity is taken out, now this year confirmed, you are low. And wait for the price to break again the structure. And again, what you can see here, you have two types of liquidity. You have the standard liquidity here, and this one, what I mean is this, let me do it here. What I mean is this. Let me do this one here, whereby the market will do this, give you the first standard liquidity. Then there's this one, it's always here. Price takes at this level here and drops to the downside. The standard liquidity is this one from your left here, but the low probability liquidity is this one here, whereby the price violates the high that created the low and later pushes to the downside. So here we have this, what we have here. Right here. Once we have this, what does that mean? The price once it has taken out that level. So if you identify this level as your supply zone, it can have a higher quality because on the left, liquidity has been taken out, and you can see the institutional candle with the high momentum leaving the zone very fast, right? And you can see some accumulation here. So if you position yourself somewhere here, you have a higher probability than right here. So let's see what happened here. You can see price will go back in that zone. If it goes back there, you can now look for short position. Let's say the entry here, put your stop loss just above the zone. Maybe here, and you will be targeting maybe, let's say, targeting this low. But I don't like buying direct. Of course, go to your lower time frame and identify a better entry to the downside. See what happened here. You can see we get a break of structure to the downside. Now, once you get this break of structure, what's your high? Your protected high is here because price went to that high and went to the downside. And you can see now what you're learning from this is that price, that's a low, a pullback to the downside. This pullback that led to a break of structure becomes of low probability. Price will go up and violate the zone. You bring this one here. Are you seeing this one? Price will go higher, violate that particular high. This one, because this here, liquidity zone. Right? This is your liquidity zone. Price will have to take out that level before it drop. And again, after you get this break of structure here, let's say you get this break of structure, if you have checked out my video on a break of structure, again, price will need the liquidity. It needs to create something like this, go down, come higher, take out this level and mitigate anything there. And again, you get a drop to the downside. So let's see what happens here. So here, once you have this level, this means that according to this structure, let's remove this one. According to this market structure from this high, this is not a pullback. This means that we need a proper pullback. The high that creates the low has to take out that level before you sell. If there's no pullback, then if there's no new pullback, then the market, this means that we have to use this high itself as what? As an inducement, because it's the high that has generated the low. So let's see what happened here. Okay. All right, for you to find a pullback, for valid pullback must be the high. For example, the high that creates a new low. So we need a new low then this one, first to consider this level as what, as a valid pullback. So let's see what happened. This low has to be broken first. Okay, let's see. Not yet broken. Cool, it's not broken. So this is what? This is your liquidity level. So this means that if you want to look for short position, if the trend is bearish, then you want to wait for the price to take out that high, then position yourself somewhere above that level for a short position. And you can see when you look on the left, everything is mitigated. Everything is mitigated here. This means that you need to be very careful when you're looking for a short position. Today, we're just going to identify liquidity levels, not entry models, and candle mitigation. So let's see what happened. Yeah. Price has to go up. You can see almost there, almost there. Yeah, price is failing to take out that high. You can see it has failed and it has generated a new low. Now, what is this? We have something like this here. This is the highest point, the low, the new high, the low. So you can see here we have two types of liquidity. Have the one above and the one here. Yeah, you see here. And most of the time, again, you'll see most people will consider this level as what? The strong supply. You want to sell from. But look at these areas. All these short positions here started from that particular high. This means that for a proper drop, you have to take out that particular high for us to get a good push to the downside. So let's see what happened here. Okay, there you can see price has gone through the level. See what happened. Okay, you can see past all the liquidity taken out. All the liquidity zones taken out. The most people will consider this level as a strong buy to the upside. The price is not buying to the upside. The price just took out the previous liquidity for buyers here. Those who are buying this move took out the level the moment it broke that structure there. So taking out this level, this doesn't mean that now the price is bullish. The price is just taking out the level, the liquidity to the upside. And once that liquidity has been taken out, we are likely to see it pushing. We're likely to see this market structure pushing to the downside. And let me show you something here. You can see, if you look at this particular market structure here very carefully, here you're going to notice something, that this black candle, the high was taken out. If the high was taken out, then this means that we have something here, maybe mitigation. This is already mitigated. Probably we have this as our hidden supply somewhere here. The price is likely to mitigate that particular zone and you get a drop to the downside. Or it can even sweep that particular high, right? There. You can see that's your hidden supply. There, let's see what happened. Okay. Let's see. That's what happened here. You can see you get a push to the downside. And now look at this. Look at this. Sorry, look at this. There's something explained earlier, and I want to explain it again here. We can see after mitigating that supply zone, the price tries to rally to the downside, tries to push to the downside, and it's supposed to now to break this low for us to get a break of structure. It's supposed to break this level for us to get a new BOS. Yeah. But the moment it's gonna fail to go to the downside, remember we talked about an internal structure. Remember earlier I said that the price would create something like this, go higher, take out the level, and it can come down, do something like this. And if it fails to take out this level, again, it needs either to take out this level or even it can go higher and take out the whole zone that generated the low before you get a push to the downside. So you end up having something like this, breakout structure here. But after taking out this liquidity, after we take out this liquidity and price fail to break the low, then it has to go higher and take out the major high that generated the low, the downside, which is a liquidity like that. After taking out that level, then stopping out people who are looking for short position here. then that's when you'll see it pushing to the downside. So this is what you're seeing here. This is what you're seeing here. Look at this price reaching here, and look at this. Let's see. Can see trying to push high. If it's gonna push higher, then this is our most recent pullback. Look at this, right? You can pull back. Then here, this means that the price it has liquidity here and above that zone. So what does it mean? It means here there's liquidity here, this pullback, and here, and probably for those who are selling above that zone. So price might want to go even past the source of the push to the downside here. Must try to go higher like this, collect all those levels, then get a push to the downside. So let's do this here, delete this level. So let's see what happened here. Okay, trying to go higher. Got that. This level, all those levels taken out, you can see. Now everybody has been stopped out, and let's see what happened. After stopping out everyone, then we see we want to come down because it's the area, a valid zone that should be broken as a break of structure here. So let's see what happened here. Okay, now we want to get a valid break of structure. Good, we have now candle close. So is your protected high. This is your protected high because previously we see the way the market has been doing this from that high here, liquidity. Price takes out that liquidity again, push high. You can see something like this. Downside, go higher, takes out that liquidity, tries to create what we call some internal pullbacks, form of liquidity goes higher, and takes out that liquidity level and break the structure here. This means that again, when the price wants to go down, it needs what we call liquidity and a push to the downside. Let's look at this structure here first before we proceed. This structure here, I want you to look at this structure very well on this particular structure here. Let me make it look a little bit better. Yeah, like that. So you can see what is the price doing. Collecting some liquidity and breaking the structure. Breaking the structure, and is your low, your protected high. The protected high is the high that when it's broken, get a change of character. Look at this. Price generates what you call trend line liquidity. This is what we call the trend line liquidity. Yeah. It wants to sell, it has to go higher, create some internal structure, and creates step 2 form of inducement, which is a liquidity. And it can either mitigate a level above that zone, a supply zone above that zone, or even it fail just with liquidity and goes low. And this year, once this high was taken out, this particular trend line liquidity here, then this year was your protected low. Now, once we get a break of structure here again, like this, break of structure here, then this is your protected high. Price should not violate that high. And again, look at this. For continuation, again, it needs liquidity. All right, once it takes out liquidity, it can go higher and break the structure again. So what do we have here? What we have here is that the price has now broken the structure and we have another protected high. So we need liquidity. Where do we have our liquidity? Look at this. High, low, first pullback, and price needs to take out this level for us to start looking for a short position. So as for now, after the break of structure, this is my liquidity zone. So let's see what happened here. Price has to go higher and take out that level. Now, can see price just playing around, failing to take out that level. Just to take out that level. Now, that level has been taken out. You can see, taken out. Now, this is our valid, our low. Now, where do we have, we can see we have an accumulation of a supply zone here and you have another zone above here. These zones are not mitigated. So the price has taken out liquidity, but the zone have not been mitigated. So here we can see If this price wants to go higher, it has two ways. They can either peak because it has swept liquidity, and on this other side, we have what we call internal liquidity. Look at this here, and came here, already took out this internal liquidity. So it comes back here, it will just go up direct without collecting anything. For example, what I mean is this. This was the low, the internal liquidity. That's something that we'll cover later, low that caused the high taken out. If the price creates what we call accumulation here, there's a zone whereby you will trade without liquidity the moment you understand how liquidity works. If it comes here, it will just pump higher. For example, if it comes around this zone, you can just tap on this zone and go higher, mitigate this supply zone before we get a sharp drop to the downside, or it can go even to the extreme supply zone there. So it will depend on how the pressure of the market will be. So let us look at this. We'll and see something here. So let's see what happened here. Okay, mitigation of the level right now. Okay, price reacted here and it has gone to the downside. Okay, that did not happen. So let's see. If it did not happen, what are we learning from this? But you can see the reaction here because the trend is bearish and this level did not hold. So what do we have here? Do we have a break of structure? Okay, we have a break of structure. So if we have a break of structure, then this should be our protected high that should not be violated. But what if the price now, if the price has broken that structure, sorry, price has broken this structure to the downside, we need a pullback, and we don't have a pullback here. If the price start going higher, this level is going to act as what? As our liquidity level, because it's the high that has led to the break of structure. For example, if the price do something like this and takes out that high, and just go down directly and break the structure without giving you an inducement, then this is your liquidity level. Price has to take out that particular high for it to go to the downside. So let's see what happened here. So as for now, if the price has not taken out this, does not create a new liquidity, then it has to use that particular high as what? As a liquidity level. So let's see what happened here. Okay, price kept pushing to the downside. Price kept pushing to the downside. Now, and you can see most of the time when the market takes a liquidity, sometimes it doesn't mitigate anything. It just drop, right? It will just drop. Look at this. Takes out the liquidity and just went to the downside without mitigating any supply or a demand zone. So what do we have here? If the price starts going higher, all right, if the price keep going higher, then this is we'll do what we call structure transfer. We'll do what we call to a structure transfer. We'll transfer this liquidity level from this zone where it is to here. Example, what I mean, we'll do this here, and this high here will be removed, and even this low again here will transfer it to here, whereby we expect a new break of structure. So this low will come here, and this only becomes a valid low only if the price goes higher, takes a lower level, and gives you a new drop to the downside. So let's see what happened here. Okay. But if the price breaks this level, then we have to look for a new liquidity level. So what happened? Price now takes at that level. This becomes a valid low, and you still have those levels unmitigated, and your swing high or your range of the price is between this high and this low. So if you want to sell, you just need to look at the location of this supply zone. Is it on extreme? Is it on discount? Is it on equilibrium? For example, if I do this here using my gun box, this low, I see this is a discount level. I cannot sell here. This again is equilibrium level. I'll not sell here. But if the price comes here, I'm interested to look for sell position. So that's just an idea, but let's see what happened here. Okay, price goes higher. It gets that level. So let's see if we're going to get a drop to the downside. Okay, we get that drop there. So we have broken the structure there, and as you can see, we have broken that structure, and the momentum of this market structure is still bearish like this. Yeah. If we break that structure, then is your protected high. This is your protected high because price went there, went to the downside and broke that structure. So where do you get another inducement? Look at this. First pullback, second, third. This is your first, because most people will always look at this zone as what? As an area of interest to look for sales from. But you realize that this zone is just a low probability zone because above this high, there's what? There's liquidity. There's liquidity here. And only until this level is taken out, for example, you want to look for proper sell if the price takes at that level, then you can do it. You can look for sell position. Example like that. Sorry. Okay. That the zone has been taken out, as you can see. We do this here. You can see if we zoom in a little bit more clear, we're going to see that high was taken out and the price started rallying to the downside. So you can see after we break this structure, for example here, we get that break of structure, boss. Now, we need a protected high. This high is now not protected. This is not a protected high because we don't have what? An internal pullback to be taken out for price to go down. So this means that this high again is likely to be used as what? As an inducement like that. This, because the high that has generated the low, market is likely to do it. To go higher after breaking the structure is likely to do it. To go higher, takes out this level before a sharp drop to the downside. So let's see what happened here. Okay, price has generated a new low here. So this means that the inducement is now here. And this high now becomes your protected high. So let's see what happened after that. Need to take out that particular high. You see this high taken out. Now price has a room now to go to the downside because this now the new lower low, and there's a lower low here. So let's see what happened here. Okay. Okay, now we have that break of structure here again. Look at that, we have a new break of structure here. And this here protected high because price went there and broke the structure to the downside. So again, where do we need our inducement? We need our inducement here. Form of liquidity there. If we take at that level, then can look for short position again. So price went down and you have to move your liquidity here because most people will be looking to look for sales here. So let's see what happens. Price went to the downside and the market keeps going to the downside. You can see this becomes our new liquidity level. Sorry. Once it takes this level, we're likely to see that drop to the downside. And until we close above this zone is when we'll say that we have a change of character. Example, until you close up there with the candle, that's when we have a change of character. If we don't close up there with the body, there's no change of character there. Example, you see the price went there, and if it just swept that level, right? If it just sweeps this level and doesn't close above it, we are still bearish because we have not closed above there. So let's see what happened. What is that? It kept sweeping the high, and that's where we are. Look at that. Price is failing to close above the zone with the body of the candle because if we close up there with the candle, then we have a change of character. So what is this here? We don't have this is not a change of character, but this is an internal structure to the upside, and we'll expect the price to continue pushing to the downside. So let's see what happened. You can see there, and you can see this even an internal structure. An internal structure is whereby the price, look at that. Price kept going lower. It can even come here and take out this high, this one or this one, and you go to the, can push to the downside. So guys, I think the next video will proceed from there. So I'll reach here for today and you will see what will happen in the next video.